What if you could shield your hard-earned money from a crashing Australian stock market and still come out ahead? Sounds like a tall order, right? But here's a wake-up call. In the first 4 months of 2025, the ASX 200 has plummeted by 8%, wiping out over $100 billion in wealth across the nation. That's enough to buy every house in Perth twice over. Right now, thousands of Australians, from young professionals in Brisbane to small business owners in Melbourne, are staring at their CommBank app, watching their superannuation and share portfolios shrink, and asking themselves, how do I keep my financial dreams alive? Maybe you're feeling it too. That knot in your stomach when you hear about another market dip, wondering if your plans for a comfortable retirement or that dream home on the Gold Coast are slipping away. I'm here to tell you it doesn't have to be that way. In this video, I'm going to walk you through 4 powerful strategies to protect your investments, no matter how wild the ASX gets. Whether you're just starting out in Canberra, building wealth in Sydney, or even an expat in Adelaide trying to crack the Australian financial system, these tactics are designed for you. After a decade of studying markets, from the ups and downs of BHP to the rise of tech stocks like Afterpay, I've seen what works and what doesn't. With the Reserve Bank holding interest rates steady at 4.35% in 2025 and global trade tensions shaking things up, now is the moment to take control. Here's what you'll get today. A clear plan to safeguard your superannuation against market slumps, smart ways to diversify your investments beyond the ASX, and even how to spot opportunities when others are panicking, all tailored to Australia's unique financial landscape. By the end of this video, you'll feel confident, not just to weather this storm, but to build wealth for the long haul, whether that's retiring in style in Cairns or funding your kids' future. Why does this matter now? Because every day you wait, the market's volatility could cost you thousands. Money that could have been a deposit on a Tassie getaway or extra years of financial freedom. So, grab a flat white, settle in, and let's turn uncertainty into your greatest asset. Ready to protect your future? Let's dive in. Let's set the scene. It's 2025, and being an Australian feels like running a marathon with weights strapped to your back. The cost of living is relentless. In Sydney, the median house price has soared past $1.6 million, according to CoreLogic, meaning even a modest home in the suburbs is out of reach for most. Melbourne's not far behind, with rents jumping 10% in the last year alone. If you're in Brisbane, you're grappling with electricity bills that seem to climb faster than a wallaby's scrum. And don't get me started on Perth. Buying a coffee in Fremantle now costs $7. For the average Australian, whether you're a young professional in Canberra, a small business owner in Adelaide, or an expat trying to make sense of it. All in Hobart, every paycheck feels like it's gone before it hits your CommBank account. Now, layer on the stock market chaos. The ASX 200, the heartbeat of Australia's economy, has tumbled 8% in the first 4 months of 2025, as reported by the Australian Financial Review. That's not just a number. It's real money vanishing from superannuation accounts and investment portfolios across the country. If you had $100,000 in an ASX index fund last Christmas, you're down $8,000 already. That's a year's worth of groceries at Woolworths or a deposit on a new ute. For many, it's a gut punch, especially when you open your SuperFunds app, say Australian Super or Host Plus, and see your balance shrinking. You can't help but wonder, will I have enough to retire, or will I be working at Bunnings into my 70s? So what's driving this mess? Let's break it down. First, global headwinds are battering Australia's markets. Trade tensions, particularly with key partners like China, have slammed our mining giants. Think BHP and Rio Tinto, which make up nearly 10% of the ASX 200. Iron ore prices dropped 12% in early 2025, dragging these stocks down with them. Second, the Reserve Bank of Australia is playing hardball, keeping interest rates at 4.35% to tame inflation, which is still hovering around 3%. That's great for savers, but it's squeezing businesses and homeowners. If you've got a mortgage in Melbourne's Inner East, You're feeling the pinch. Every rate hike means less cash for investing, or even that weekend getaway to the Great Ocean Road. Third, and this is the kicker, most Australians aren't set up to handle these shocks. A 2025 ASIC report found that 65% of retail investors in the ASX hold less than 10 stocks, leaving them exposed when sectors like mining or banking tank. It's like betting your whole super on Collingwood to win the AFL Grand Final. Hopeful, but risky. Superannuation funds aren't much better. The average Aussie has their super parked in a default balanced fund, earning a measly 4.5% annually, while high-performing funds hit 8%. That gap? It's the difference between retiring with $500,000 or $1 million by age 65. And yet, how many of us actually check our super? Be honest. When was the last time you logged into your fund's website? Then there's the emotional toll. You're scrolling X late at night, seeing headlines scream about market crashes or recession fears. Maybe you're chatting with mates at a Barbie in Manly, and someone mentions their cousin who lost thousands on a bad crypto bet. It plants a seed of doubt. Am I next? For expats, like those who've moved from India or the UK to places like Parramatta, it's even tougher. You're still figuring out what a franking credit is, let alone how to protect your savings in a system that feels foreign. And if you're a small business owner, say, running a cafe in St. Kilda, the rising cost of everything from flour to staff wages means you're too stretched to even think about investing smartly. Here's where it gets real. An 8% drop in the ASX isn't just a blip, it's a threat to your long-term goals. If your super loses 10% this year, you might need to work 3 extra years to make it up. That's 3 years. Less of sipping cocktails in cairns or road tripping the Nullarbor. Worse, if you panic and sell during a dip, you lock in those losses for good. Data from the ASX shows that investors who sold during the 2020 crash missed out on a 20% rebound the following year. Hesitation or bad moves can cost you tens of thousands, money that could have funded your kids' uni fees or a deposit on a taxi cabin. But it's not just about losses, it's about missed opportunities. While you're fretting over the market, others are snapping up bargains, stocks like Qantas or CSL trading at a discount. The wealthy don't panic, they plan. And that's the problem. Too many Australians are reactive, not proactive. We're great at throwing a shrimp on the Barbie, but when it comes to money, we often leave it to chance, hoping our super will sort itself out or that the market will magically recover. Spoiler, hope isn't a strategy. This isn't about shaming anyone, it's about facing reality. From Darwin to Launceston, we're all feeling the squeeze of 2025. The question is, are you going to let a falling market derail your dreams? Or are you ready to take control, like the savviest investors who see volatility as a chance to build wealth? The good news is you don't need to be a finance guru or have millions in the bank. You just need a plan, and that's exactly what's coming next. All right, we've laid out the problem. The ASX 200 is down 8% in 2025. Living costs are through the roof, and your superannuation might be feeling the heat. But here's the good news. You don't have to sit back and watch your wealth erode. Today, I'm sharing 4 powerful strategies to protect your investments and even position you to thrive in this shaky market. Whether you're a young professional in Brisbane, a small business owner in Perth, or an expat settling into Canberra, these steps are designed to work for you. Think of your financial plan like building a solid surfboard for Bondi's waves. Strong, enough to handle the crashes, sleek enough to ride the opportunities. Let's dive into the how-to, step by step, with practical tips you can start using today. Strategy 1. Diversify your portfolio. Like a pro, if there's one golden rule in investing, it's this: don't put all your eggs in one basket. A 2025 ASIC report revealed that 65% of Aussie retail investors hold fewer than 10 stocks, often piling into familiar names like Commonwealth Bank or BHP. When mining takes a hit, like this year's 12% drop in iron, Ore prices or banks wobble, those portfolios crumble faster than a pavlova left out in the sun. Diversification is your shield, spreading risk across different assets so a single crash doesn't wipe you out. It's like fielding a balanced AFL team. You need forwards, defenders, and midfielders to win the game. Start with the ASX. Instead of betting big on one or two stocks, consider exchange-traded funds, ETFs, like the Vanguard Australian Shares Index, VAS, which tracks the top 300 ASX companies, from miners like Rio Tinto to retailers like Woolworths. With an average return of 7% annually over the past decade, VAS offers growth without the heartburn of a single stock's collapse. For example, if you invest $1,000 monthly into VAS at 7%, you could have $300,000 in 20 years per compound interest calculations. Compare that to a single stock like Fortescue Metals, which lost 15% in early 2025. Diversification saves the day. Platforms like ComSec or Perler make it easy to buy ETFs, with trades starting at $10. Your challenge this week: log into your brokerage account and check if more than half your portfolio is in one sector. If it is, it's time to spread the love. But don't stop at Aussie stocks. Global markets can balance out local dips. The ASX 200 might be down, but tech-heavy indices like the US Nasdaq have gained 5% in 2025, driven by AI and renewable energy. An ETF like Vanguard's VEU, covering global shares, gives you exposure to companies like Apple and Tesla. Allocate 20 to 30% of your portfolio here, less if you're risk-averse, more if you're under 40. Bonds are another safe bet. Australian government bonds are yielding 3.5% in 2025, offering stability when stocks waver. You can access them via platforms like eToro or through your super fund's fixed income options. What about property? Australia's obsession with bricks and mortar isn't fading, but Sydney's $1.6 million median home price is a stretch. Instead, look at real estate investment trusts, REITs, like Goodman Group, listed on the ASX, which invests in warehouses and logistics hubs. Goodman's up 6% this year, bucking the market trend as online shopping booms. $1,000 in a rate can grow steadily without the hassle of a mortgage. Here's a quick question. Did you know 70% of ASX investors skip international and bond assets entirely? Don't be one of them. Diversify to sleep better at night. Strategy 2. Supercharge your superannuation. Your superannuation is your ticket to a golden retirement. Think sipping cocktails in Cairns or road-tripping Tasmania. But most Australians treat it like an afterthought. In 2025, the average default super fund returns 4.5% annually, while top performers like Australian Super's high-growth option hit 8% per APRA data. That gap turns a $100,000 super balance into $500,000 versus $800,000 by age 65. The difference? Smart choices now. Let's break it down into 3 actionable steps to bulletproof your super against market drops. First, slash fees. Many funds charge 1.2% annually on a $100,000 balance. That's $1,200 a year, enough for a weekend in Byron Bay. Low-cost funds like Host Plus Indexed Balanced or UniSuper's Sustainable Option keep fees below 0.6%, saving you thousands over decades. Log into your super account today, yes, right after this video, and check your fee statement. If it's over 1%, switch to a cheaper fund. It takes 15 minutes, less time than ordering a flat white at a busy Melbourne cafe. Second, tweak your asset mix. If you're under 45, a high-growth option with 70% in shares, split between ASX, global stocks, and property, can weather short-term dips for long-term gains. For those closer to retirement, a balanced mix with 40% in bonds or cash reduces risk. Most default funds are too conservative, with only 50% in shares, stunting growth. In 2025, global shares in top super funds gained 6% despite ASX woes, proving diversification works here too. Use your fund's online portal to adjust allocations. It's as easy as picking your Netflix queue. Third, boost contributions. The ATO allows voluntary contributions up to $27,500 annually with tax breaks. Adding $500 a year, $10 a week, cuts your taxable income and grows your super. For example, a 30-year-old adding $500 annually at 7% could have an extra $100,000 by 65. Ask yourself, what's one expense, like a weekly takeaway, you could redirect to your super? Small sacrifices now mean big wins later. Expats, take note. Super is Australia's version of a pension, and topping it up is easier than navigating. Medicare. Strategy 3. Build a rock-solid emergency. Fund a market crash isn't just a threat. It's a wake-up call to get your financial house in order. An emergency fund is your safety net, ensuring you don't have to sell investments at a loss when life throws curveballs, like a car repair or a slow month at your Adelaide bakery. Aim for 6 months' expenses, around $20,000 for a typical Brisbane household per ABS data. In 2025, high-yield savings accounts from banks like ING or UBank offer 3.8% interest, beating inflation. Stashing $200 monthly gets you to $10,000 in 4 years, safe and accessible. Why does this matter in a market slump? Liquidity. If your super or shares are down, dipping into them locks in losses. An emergency fund lets you ride out the storm. Plus, it's a psychological win. Knowing you've got cash in reserve feels like nailing a penalty kick in the A-League. Start small. Redirect $50 a month from streaming subscriptions or pub nights. Use a separate account labeled Emergency to avoid temptation. Quick challenge. Calculate your monthly expenses, rent, groceries, bills, and set a savings goal today. It's the foundation of financial confidence. Strategy 4. Turn volatility into opportunity. Here's where it gets exciting. A falling market isn't just a problem, it's a sale. Stocks like Qantas, down from $8 to $6 in 2025, or CSL, dropping 10%, are bargains for patient investors. The ASX 200's long-term average return is 6% annually, per ASX data, meaning dips often rebound. Those who bought during the 2020 crash saw gains of 25% by 2022. The trick? Have cash ready and a watch list of quality companies. Start by dollar-cost averaging, investing a fixed amount monthly, say $200, into an ETF like BetaShares A200. When prices fall, you buy more shares. When they rise, you gain more value. Platforms like Sharesies let you start with $50. Next, research resilient sectors. In 2025, healthcare, e.g. Ramsay Healthcare, and renewables, e.g. Meridian Energy, are up 5%, defying the downturn. Avoid the hype. Crypto's Bitcoin crashed 18% this year per CoinSpot data, so cap it at 5% of your portfolio, like a punt on the Melbourne Cup. How do you prepare? Keep 10% of your portfolio in cash or near-cash assets, like term deposits at 4%. When a stock like Woolworths hits a 2-year low, pounce. Buy 50 shares at $25 each, and a year later, they could be back to $30, netting $250 profit. Sound daunting? It's not. Open a micro-investing app like Raiz, link your debit card, and round up daily purchases to invest. Last year, Raiz users averaged $500 in gains from spare change. Here's a question to chew on. What's one stock or ETF you've been eyeing? Write it down and track its price this month. Putting it together. These strategies, diversification, super optimization, emergency funds, and opportunity hunting, work together like a well-planned road trip up the Queensland coast. Diversify to spread risk, supercharge your super for long-term growth, save for emergencies to stay calm, and seize bargains to build wealth. Each step is doable, whether you're a teacher in Darwin or a techie in Parramatta. The biggest mistake? Doing nothing. In 2025, with RBA rates high and global markets choppy, inaction could cost you tens of thousands. Money for your kids' future or that Margaret River Vineyard dream. So, what's your next move? Will you check your super fees, buy your first ETF, or start saving $50 a week? The choice is yours, and it starts now. Numbers and strategies are powerful, but stories hit home. They show how real people, just like you, can turn a falling market into a stepping stone. The ASX 200's 8% drop in 2025 is scary, no doubt, but it's also a chance to rethink, rebuild, and grow. Let's meet 4 fictional Australians, each reflecting the diversity of our audience, from young professionals to expats and small business owners, who used the strategies we've discussed to protect their investments. Whether you're sipping a flat white in Fremantle or crunching numbers in Canberra, there's something here to inspire you. These stories aren't just feel-good tales. They're proof that anyone can take control, no matter where you're starting from. Story 1. Jake, the Sydney tech worker who diversified his way to confidence. Jake, 31, is a software developer living in Surrey Hills, Sydney. He's got a solid job at a fintech startup, pulling in $120,000 a year, but his financial life used to be a mess. Jake loved the thrill of investing and had sunk $30,000, his entire savings, into 2 ASX stocks, Afterpay and Fortescue Metals. Tech and mining are Australia's backbone, he'd tell mates over beers at the Lord Nelson. But in early 2025, when Afterpay dipped 10% on US tech fears and Fortescue tanked 15% with iron ore prices, Jake lost $6,000 in weeks. His CommBank app became a daily nightmare, and he started wondering if he'd ever afford that deposit for a Bondi unit. Feeling stuck, Jake stumbled across a finance podcast while jogging around Centennial Park. It hammered home diversification, and he decided to act. He sold half his Afterpay shares, not at a loss, thankfully, and moved $20,000 into the Vanguard Australian Shares ETF, VAS, covering 300 ASX companies, from CSL to Woolworths. To hedge against local slumps, he put $5,000 into the Vanguard Global Shares ETF, VEU, tapping into giants like Microsoft. He also allocated 10% of his portfolio to Australian government bonds via his super fund, yielding 3.5% in 2025. When the ASX fell another 5% mid-year, Jake's losses were only 2%. His global shares gained 4%, cushioning the blow. Today, Jake invests $500 monthly across his ETFs, using Perler for low fees. His portfolio's back to $35,000, and he's eyeing $100,000 in 5 years, assuming 7% returns. Before, he was glued to stock charts, stressed out. Now, he sleeps easy, knowing his money's spread like a well-planned BBQ spread. Jake's tip? Check your portfolio balance. Mine was way too heavy in tech. Here's a question for you. How many stocks or sectors dominate your investments? If it's less than 10, Jake's story might be your wake-up call to diversify, just like picking a varied team for the AFL Fantasy League. Story 2. Priya, the Melbourne nurse who transformed her Super Priya, 39, is a nurse at Royal Melbourne Hospital, living in Footscray with her husband and 2 kids. Between shift work and school runs, money was always tight, despite her $80,000 salary. Her superannuation, sitting at $90,000 with SunSuper, was something she ignored. It's for old age, right? She'd joke. But in 2025, a colleague mentioned how super funds were struggling with the ASX's 8% slide. Priya checked her account and saw her balance had barely grown in 2 years, stuck in a default balanced fund, earning 4.5%. With house prices in Melbourne hitting $1.4 million, she panicked. How will we ever retire? Without selling the house? Determined to fix it, Priya spent a weekend researching. Over chai, not coffee, as she laughed. She discovered her fund charged 1.3% in fees, draining $1,200 yearly. She switched to Australian Super's indexed balanced option with fees at 0.5%, saving $800 annually. Next, she adjusted her allocation, 60% to shares, half ASX, half global, 20% to property, and 20% to bonds. This mix gained 6% in 2025, despite the market dip, growing her super to $96,000. Priya also started voluntary contributions, $200 monthly or $10 a shift, claiming tax deductions via the ATO. That alone added $5,000 to her super in a year, tax-free. Now, Priya's super is on track to hit $300,000 by 55, assuming 7% returns. She's dreaming of a Tassie holiday home, not just scraping by. Before, she felt clueless. Now, she's the one giving super tips at the hospital cafeteria. Her advice? Spend 10 minutes on your super's website. It's easier than charting patient vitals. So when did you last check your super fees? Priya's story shows that a small effort now can mean retiring to St. Kilda's beachfront, not stressing over bills. Story 3. Tom, the Perth Cafe. Owner who built an emergency fund, Tom, 44, runs a bustling cafe in Leaderville, Perth, serving avocado toast to hipsters and tradies alike. His business nets him $90,000 a year, but 2025's high costs, think flour up 15% and wages climbing, left little for savings. Tom had $10,000 in an ASX portfolio, mostly in Wesfarmers, but when the A market fell, his shares dropped 12%, costing him $1,200. With no cash buffer, he nearly sold at a loss to cover a broken espresso machine. I felt like I was one bad month from closing shop, he admitted over a beer at the Leaderville Hotel. A mate suggested an emergency fund and Tom got to work. He opened an ING Savings Maximizer account, offering 3.8% interest in 2025, and committed to saving $200 monthly, skipping one weekly pub trivia night. In 18 months, he had $4,000, enough for most emergencies. When the ASX dipped again, Tom didn't flinch. His shares stayed put, recovering 5% by year-end. He also redirected cafe profits to save faster, hitting $10,000 by mid-2025, covering 6 months. Of personal expenses, about $1,600 monthly in Perth per ABS stats. That buffer gave Tom peace of mind, like nailing a perfect flat white under pressure. It also let him sleep knowing he wouldn't raid his super or sell stocks in a panic. Before, he lived paycheck to paycheck. Now he's eyeing a second cafe in Fremantle. Tom's tip? Start with $50 a month. It adds up. What's one expense you could cut to build your own safety net? Tom's story proves an emergency fund is your financial lifeboat, ready for any market storm. Story 4. Aisha, the Adelaide expat who seized market opportunities. Aisha, 28, moved from the UK to Adelaide 2 years ago, working as a marketing coordinator with a $65,000 salary. As an expat, she found Australia's financial system daunting. Super, franking credits, and the ASX were all new. She had $5,000 saved but kept it in a low-interest bank account, earning 1%. When the ASX crashed 8%, friends warned her to stay away from stocks. But Aisha saw posts on X about buying low. If Qantas is on sale, why not? She thought, browsing markets during her lunch break at Rundle Mall. Aisha started small, using Rise to round up purchases, like her daily coffee at Cibo, investing $10 weekly into the Beta Shares A200 ETF. She also built a cash reserve, saving $100 monthly in a Ubank account at 3.7%, hitting $2,000 in a year. When CSL, a healthcare giant, fell from $300 to $250 per share in 2025, Aisha used $1,500 to buy 6 shares via ComSec. By late 2025, CSL rebounded to $280, netting her $180 profit. She kept investing $200 monthly into A200, averaging 6% returns despite the volatile market. Aisha's now got $8,000 invested, with plans to hit $20,000 by 30. Before, she felt like an outsider in Australia's markets. Now she's as confident as a local cheering at the Adelaide Oval. Her advice? Track one stock for a month. It's less scary than it seems. What's stopping you from dipping a toe in the market? Aisha's journey shows that even newcomers can turn a crash into a win, like finding a gem at the Barossa Valley markets. Why these stories matter? Jake, Priya, Tom, and Aisha aren't finance gurus. They're Aussies like you, from Sydney to Adelaide, facing the same 2025 challenges. Jake spread his risk, Priya boosted her super, Tom secured a buffer, and Aisha grabbed bargains. Together, they show that protecting investments isn't about luck. It's about action. Whether you're a tradie in Darwin or a teacher in Launceston, their wins are within reach. Which story resonates most? Maybe it's time to write your own, starting with one small step, like checking your super or saving $10 this week. Building wealth in a turbulent market is like sailing the Sydney to Hobart yacht race. You'll hit rough seas, but with the right navigation, you'll reach the finish line stronger than ever. Today, we've charted a course through the chaos of 2025, with the ASX 200 down 8% and the cost of living squeezing wallets from Darwin to Launceston. You've learned 4 battle-tested strategies to protect your investments and turn uncertainty into opportunity. Let's recap, because this is the map to your financial future, whether you're a young gun in Brisbane, a family in Perth, or an expat finding your feet in Parramatta. First, diversification. Spreading your money across ASX ETFs like VAS, global shares via VEU, and safe bets like government bonds. It's your financial seatbelt, keeping you secure when stocks like BHP or Afterpay take a dive. Second, superannuation. Optimization, slashing fees, tweaking allocations, and adding contributions to transform your super from a sleepy default fund into a wealth-building machine, like Priya did in Melbourne. Third, an emergency fund, a cash buffer in high-yield accounts like INGs, ensuring you never have to sell investments in a panic, as Tom learned in Perth. And fourth, seizing opportunities, buying quality stocks like CSL or Qantas during dips, just like Aisha in Adelaide, to grow your wealth when others hesitate. These aren't pie-in-the-sky ideas. They're practical steps, grounded in Australia's reality, from the Reserve Bank's 4.35% interest rates to the $1.6 million homes in Sydney. Picture this. It's 2035 and you're kicking back on a balcony in Cairns, the Coral Sea sparkling below, your super balance sitting comfortably at $1 million, or maybe you're road tripping the Great Ocean Road, debt-free with your kids' uni fees sorted, because you acted now. That's not a fantasy, it's what happens when you take control. Jake diversified his portfolio and saved his Bondi dreams. Priya turned her super into a retirement lifeline. Tom built a safety net to keep his cafe thriving. Aisha, new to Australia, bought low and won big. They're not smarter or richer than you, they just started, and starting is the key. The ASX might wobble, with mining stocks down 12% and headlines screaming doom, but history shows it rebounds. Since 1990, the ASX 200 has averaged 6% annual growth per ASX data, despite crashes. Your job? Stay in the game, not on the sidelines. So, what's holding you back? Maybe it's fear of losing money, of not knowing enough, of making a mistake. Let's be real. Every Aussie investor, from the big shots at Macquarie to your mate who bought Qantas shares, feels that sometimes. But fear doesn't build wealth. Action does. You don't need a finance degree or $1 million to start, just a decision. Maybe it's logging into your super account to check fees, setting up a $50 monthly investment in an ETF, or opening a savings account for emergencies. Small moves today, like betting on a roughie in the Melbourne Cup, can pay off big tomorrow. The cost of waiting? Huge. A 10% market drop could shave $50,000 off a typical super balance of $500,000 per APRA stats. That's years of extra work, or a missed chance to buy that tassy weekender. Here's my challenge to you. Pick one action from this video and do it this week. Check your super fees. 10 minutes online, done. Buy your first ETF share. $50 on ComSec, sorted. Start an emergency fund. $20 in a Ubank account, easy. Why this week? Because 2025's market isn't waiting. With global trade tensions and RBA rates squeezing, every day you delay is a day someone else is grabbing bargains or securing their future. You're not just an investor. You're part of a generation redefining wealth in Australia, from the beaches of Gold Coast to the vineyards of Margaret River. You've got the tools, the stories, and the know-how. The only question left is, what's your first step? Imagine looking back in 5 years, knowing you started today. How good would that feel? Before you go, I need your help to spread this message. If this video clicked for you, if it gave you one idea to protect your money, hit that like button. It's a small click that tells YouTube to share this with more Aussies, from Darwin tradies to Adelaide teachers. Next, share it with a mate. Maybe that friend in Manly stressing over their portfolio, or a colleague in Canberra new to super. Sharing's like tossing them a lifeline in choppy waters. And please subscribe to the channel. Click that bell so you don't miss what's next. In my upcoming video, I'm diving into the ASX sectors poised to soar in 2026, like renewables and healthcare, plus the traps to avoid. You won't want to miss it. One last thing, let's build a community. Drop a comment below and tell me, what city are you watching from? Sydney, Perth, Hobart, or maybe a regional gem like Albury? Bonus points. Share which strategy you're trying first, diversifying, super tweaks, saving, or buying low. Your comment inspires others, like a shout-out at the AFL Grand Final. Together, we're not just surviving this market, we're thriving, building wealth for barbecues, Bali trips, and beyond. Thanks for being here, legends. Let's make 2025 the year you take charge. See you in the next video.